Chairman McWilliams, thank you so much for being with us today. We appreciate you being with us virtually. You were here with us at our 133rd convention 2 years ago here at Mackinac. You were the star of our show then when you were here in person just for your few hours on the island, and we know that you will be a star today virtually. Thank you so much for being with us.
Oh, thank you. And I have to tell you that trip to the Mackinac Island and your event was like one of the highlights of my outreach and the first couple of years at the FDIC. And I remember coming back to DC and I was like, we took 2 planes, 1 car, 1 ferry, and 1 horse buggy. And then we were there and it was incredible. And the people were so warm and welcoming. And it was just such a wonderful event that I wish I could have spent more time. But I do remember it very fondly. And thank you for inviting me again.
Absolutely. We'll look forward to having you back as well. And speaking of being welcoming, during the past year, I just want to compliment you and really the entire agency on the way that you have been accessible to banks and to trade associations. You've been a special guest on our early morning time with bankers very often. We are especially grateful for the relationship we share with the Chicago office, with John Keneally and Teresa Savanti, and Chris Newberry meets with us on a monthly basis, which we're very grateful for. We met just this week with Greg Baton, so we're looking forward to his leadership there as well. So thank you for the hospitality with which your team greets
Thank you.
us.
Thank you for
Thank you.
those.
Again, thank you for being with us today. Would you share with us just how things are going for the agency, how you responded to the pandemic, and what you see as the immediate future?
Sure, no, great questions. And I will tell you, I would gladly rewind back to the event at the Mackinac Island and wish that some of the things that happened since then did not, namely the pandemic. And so I'll say that, we had what I would call a very challenging year and a half, not just at the FDIC, but as a country and in the world as well. As you know, the pandemic came upon us pretty abruptly. And I frankly, personally, I've been monitoring the pandemic since December in China of 2019. But I didn't think it would be, even if it came to the United States, I thought it wouldn't be as big as it ended up being, because I thought it was going to be more like the bird flu in 2007-8 than what we ended up here. So I will say that from that perspective, most of us in the United States probably did not anticipate complete government shutdowns of business activity in each state, which, as you can imagine, impacts the frontline workers on the front lines, the banks, and the banking industry pretty heavily. And I will tell you that if you ask me in March of 2020, when the pandemic was declared a national emergency and the multiple states started issuing stay-at-home orders, and which closed down the economic activity, had you asked me back then, how do you think the banking industry would fare? I would probably put on a brave face, smile, and say, oh, I hope well. But even in the most optimistic of the scenarios, I don't think that I would have predicted with certainty or courage how well the banking industry has actually handled the pandemic. And I really want to take my hat off to the community bankers on this call as well, because we all know that it was tough staying in business, and it was tough being on the front lines helping your customers. And I know that there are bankers out there who did not close their branches throughout the entire pandemic. So they had the people show up to work as essential workers to make sure there are banking channels and services available to their customers. And I really want to thank you for that service to the country. And the banking industry overall has actually handled the pandemic really well, surprisingly well in many cases. If you look back at Q2 of 2020, we had the general GDP drop of about 33% on an annualized basis. So it's the largest single drop in our quarterly domestic gross domestic product that we have ever had since the GDP was recorded, began being recorded in, I think, 1948. And so when you look at such a drastic impact on the economy, and all of a sudden you see that banks, when you look at the revenue and everything else for the banking industry, yeah, there were dips in the revenue because primarily of the net interest margin, et cetera, other developments that were outside of the banker's control. But really, the industry has done remarkably well. The amount of capital and liquidity has increased in most banks. And shockingly, even more so, I'm at liberty to disclose this much. We even had more banks move from being 3 and 4 rated to being 2 and 3 rated and 1 and 2 rated than we did in the past. So I would say that if the pandemic taught us anything, is that nothing is normal anymore, and we have to kind of adjust to the circumstances that are not always predictable. And certainly, the banks have shown requisite resilience, both in their operations and their ability to serve their customers and communities. That there's much to be learned about that. I'm also really pleased with the amount of deposits that flocked to the banking industry. And I joke that early on in the pandemic, we heard anecdotally that people were pulling large cash deposits from the banks because they were concerned with the economic shutdown. Should I have my money in the bank or not? And if you recall, there was a period in time back in March of 2020 where the Federal Reserve, they sent the money wagons. I call them money wagons to the secured cash distribution to different banks and other facilities. And they were running out of. They had to dispatch additional vehicles to send cash because people were pulling cash out of the bank. So we did a public service announcement, basically saying, "Your money's safe in the banks. Keep your money in the bank. The banks are insured." And lo and behold, going from having fear that people are going to be pulling money out of the banks, we went to unprecedented deposits at banks, in large part because of the government action and the multiple rounds of stimuli that Congress ended up passing
Right.
and giving to the citizens and businesses. But we had about $3.3 trillion in new deposits come to banks last year. And so that is an unprecedented growth of the deposits that we have seen. It has continued in 2021, and so we're just kind of trying to figure out what is the new normal. The good side of that is that there's confidence in the banking system. People are comfortable keeping their money at the banks. We got more unbanked customers to open up banking accounts in order for them to be able to receive government funds. The downside is that it's not normal, and it has thrown liquidity and capital ratios at banks off, and as banks are looking for different channels to dispatch funds, the unprecedented amount of government support to individual citizens and small businesses has also resulted in reduced lending demand. So that has also created an issue for the bank. So I think everything is, you have to look at everything from all angles and sides, but overall I would say the banking industry has handled itself remarkably well. Our job as regulators was to make sure that you can continue to serve your communities, and for us to remove any roadblocks that may be ahead of you. So I don't want to even mention all of them, but we entered into a number of regulatory actions to allow you to work with your customers and to allow your customers to stay in their homes, have access to credit. We temporarily reduced community bank leverage ratio to 8%. We suspended the treatment of loan modifications that were performing before the pandemic, that were being modified for the purposes of the pandemic. And as a result of the pandemic, we made sure they were not classified as troubled debt restructuring so that you wouldn't have impaired loans on your portfolios, et cetera. And so I'm really proud of the regulatory efforts as well that we had on an interagency basis with the Fed and the OCC. And I'm just really grateful that people who were leading those efforts at the other agencies were the right people for the job. They had ample experience in the financial markets, and they understood how the markets move. And I thought that was really important in order for us to be able to act as quickly as we did. And it was very quick. So I want to leave us enough time for questions and answers. I could go on for a long time about our response to the pandemic. If I had a great book coming out, I would say buy my book, but I don't. So you'll just you can field some of the additional questions in the Q&A session.
Well, we'll look forward to that book when it does come out,
Someday,
Madam Chair.
someday.
And thanks for being with us and for what the agency has done, and also for acknowledging what our banks have done. They really have been just tremendous in their response. You mentioned the relaxation of some of the regulations in order for banks to work with their customers. What my bankers are sharing with us is that really the delinquencies are much lower than they anticipated at the beginning of this, as you alluded to. We just want to be sure that as we go forward in time, that that the examiners remember and recognize the encouragement to work with customers, and remember that if as things go along going forward.
Yeah, yeah, absolutely.
Absolutely. Um, the Community Reinvestment Act.
Sure.
There's been
Can you
lots of.
start with a difficult topic? Can you start with something fun? No, I'm kidding. Go ahead.
Tell us where you think we are there and how that might be moving forward in the next year or so.
Sure, sure. So as you know, the three agencies, the Fed, OCC, and the FDIC, worked together. At some point, the negotiations broke down, and it ended up being the OCC and the FDIC issuing a notice of proposed rulemaking. And then along the way, the pandemic struck, and so OCC did finalize its rule. And I didn't think it was appropriate at the time when we were dealing with the banking issues around the country early on in the pandemic. I didn't think it was appropriate to finalize the CRA rule for our banks. So we didn't. So the only rule out there, really, the new rule, is the OCC rule. The Fed and the FDIC are still functioning with the old rule, really, that has not been meaningfully updated since 1995. I still believe that there is an opportunity that we should avail ourselves of coming up with a uniform approach among the three agencies to the CRA. I know there are many issues with the way CRA is set up right now, namely with how to accommodate the changes in technology and the banking channels and how people utilize banking channels. What is a branch anymore when a lot of people don't come inside of the branch, et cetera, and to provide more certainty, frankly, to financial institutions as to what activities and products qualify for the CRA, so that 3 weeks before examiners come in, you're not looking through your files trying to make sure you have enough to get an outstanding rating. I will also, or satisfactory in some cases, or I will also say that we don't know what's going to happen with the OCC rule. We all heard Acting Comptroller Sue mention, some suspension. I don't know legally exactly how they're going to do that. There are procedures in place if you want to suspend implementation of the rule. And so I'm not sure how the OCC will deal with that. But I can tell you that we are engaged with the OCC and the Fed in reviewing the 600 plus comment letters that the Federal Reserve has received on its advance notice of proposed rulemaking that they issued back in September of last year. They had a long comment period of 120 days. So those comments came in and we're reviewing them, and then we'll just have to regroup with the Fed and the OCC to see how much appetite there is to move forward. But I would say for at least the FDIC banks, continue doing what you're doing with respect to the CRA. There's no change. The proposed rule we had out there with the OCC, I call it's been shelved. We can take it all down from the shelf, but I certainly wouldn't do that during the national emergency and the pandemic. And by the way, we're still in the national emergency and the pandemic, so I just don't think it would be appropriate to make any changes to the path that I had outlined when the pandemic struck and the national emergency was declared. So I would say that's that's kind of the honest assessment, even if it's not very specific. But I would just continue to urge FDIC banks to continue doing what they're doing, because really there's no change in our approach based on the proposed rule or the advance notice of proposed rulemaking from the Fed or the final rule from the OCC.
Appreciate that perspective very much. You mentioned comment letters and 600 comment letters.
600 is nothing. 600, when I worked at the Fed, I think this was on high cost loans. I had to review something like 3,000 comment letters dealing just with the escrow requirement. So 600, it's still complicated because it's three agencies and you have to go very thoroughly through each letter. But it's not a tremendously high number. It's a high, but it's not tremendously high.
Remind our bankers, how important is it to write a comment letter?
Please do. And here's why. We really appreciate getting comment letters. We don't do notice and comment process just because the Administrative Procedures Act, the law, requires us to do it. We do it because it's the best opportunity for us to seek your feedback. And why it's really important that if you can send a letter, please do, is that you give us a unique perspective. And here is what's great. Your trade associations, no offense, MBA, your trade associations will give you a template sometimes, and you sign a template, and then we get 300 of the same letter. That's fine. But if you're like, let's say Bank A in a small rural community, you have two branches, and you send a half a page, one paragraph letter that says, listen, we are a small rural bank, two branches, and this is the impact this rule will have on us. That is actually so much meaningful. There's so much meaning to in that just one paragraph to us, because you know what? Two things. One, it's a perspective we may not get otherwise unless a very small bank speaks. And two, we have to respond in our final rule to the comment letters. So if you give us an issue that has not been identified by anybody else, and you say something along the lines of, well, if you implement that rule as proposed, I will need to hire another person. I can't hire them for less than $100,000, and I already have 4 or 5, 6 employees. That's going to be significant impact on our ability to invest in technology. Like, that's actually meaningful, believe it or not. So you don't need to have these super sophisticated letters that cover every legal angle, go
Right.
through constitutional law analysis. No, you just need to give us your feedback. And so I would really urge you, when we open up something for notice and comment, we don't do it just because we're required to do so by law. We do it because we genuinely want to get your feedback. And I would urge you to, in addition to sending mass letters that you may get from your trade associations, send that individual letter, because you never know. And I will tell you that as a staffer at the Federal Reserve, I remember getting my 3,000 letters, going to
Sure.
them, and being in the meetings with other people working on the actual language of the regulation as we were drafting them, and thinking, no, but there was a little bank in, Wyoming, doesn't matter, someplace, that sent this letter and they said something really interesting. How are we going to respond to that? And
Right.
so never underestimate the impact of one letter, your letter.
Well, that's important and very well said. Thank you for sharing that. And something that our banks often speak about are some of the inequities in uh, in the financial services marketplace. When you think about uh, your banks, credit unions, industrial loan companies, fintech, etc. And I know you've been asked some questions on the Hill, et cetera. But how do you feel about Congress's perhaps failure to address the inequities in regulation? How that might be hurting depository banking and long-term safety and soundness of the industry?
So as somebody who has to testify before Congress, I'll say, what failure? I don't know what you're talking about. But as a regulator, I will tell you this. We're cognizant of, I would say, disparate treatment for different forms of entities based on their charter. So that's it doesn't escape me that if you're a state bank, you have to register to, originate mortgages and service mortgages, two different licensing requirements in every state where you offer that, right? It doesn't escape me that ILCs do not have a bank holding company at the Federal Reserve, so we have imposed requirements on them that would emulate the requirements they would have if they had a bank holding company. I can't do a whole lot with credit unions. There's always the issue of taxation and them having to comply with the Community Reinvestment Act. They do have a cap on member business lending, but they've been changing the definition of the field of membership, so more members become members. So I'm keenly aware of all of those issues, not just from this position at the FDIC, but also having been a general counsel at a large regional bank, and before that, having worked on the Senate Banking Committee on these exact issues. I will tell you this, that I can't speak for the rest of the government, I can't speak for the rest of the regulatory agencies, but I can speak for the FDIC, at least during my tenure here. The bottom line is that we're aware of different frameworks for different entities, and so we try within our tool chest, our regulatory tool chest, we try to make sure that the playing field is as leveled as possible. And I'll give you an example. People complain about the ILCs. Banks complain about the ILCs,
Sure.
I'll be honest. And here's the bottom line. I don't love them, I don't hate them. Congress gave us literally the same language to approve a deposit insurance by an industrial loan company, industrial loan bank, as it does for a de novo vanilla community bank. And so we have to apply those rules as Congress gave them to us, because I never, ever, ever want to be accused as a leader of this agency during my tenure that I acted, arbitrarily and capriciously in my approach to regulations. So if these are the same rules for the banks as they are for the ILCs, we have got to apply them uniformly. Now, what we do on the back end of regulation, we actually understand that banks will have a holding company. Most banks will have a holding company that's regulated by the Fed. Their holding company requirements in capital and liquidity by the Fed, et cetera, et cetera. So we know that's not the case for the ILC. But the statute to approve the deposit insurance is the same. So what we do on the back end, we use our supervisory tools. And before these entities get approved for deposit insurance, we will ask them to enter into a capital liquidity management agreement and the parent company agreement, where basically the parent obliges itself to provide capital liquidity to the IDI, insured depository. We actually impose really high depository requirements, capital requirements on the ILC that in some cases are 20% of capital. And so we do try to kind of ameliorate the discrepancies in the regulatory framework to the extent that we can. And I quite often tell the banks, don't blame me for approving, ILC applications for deposit insurance if they meet statutory requirements, right, because we're applying the same rules. Now, we do treat them a little bit differently when it comes to capital and liquidity and this parent's obligation, but it's something that we can because we have supervisory authority to do so. So I will say that, short answer is we use all the tools, regulatory tools we have in our chest to make sure that we understand the discrepancies in the regulatory framework among different entities based on their charter, and we try to do as much as we can to create parity among
Absolutely.
them so they can actually compete effectively.
Appreciate that perspective very much. Thank you. When you mentioned rural areas, and diversity, equity, and inclusion has been a subject that's been elevated a lot in the past year. When you think about that small bank that you mentioned in a rural area that perhaps feels it doesn't have a lot of diversity in its community, especially when you're thinking about race, perhaps. How does that institution really explore diversity, equity, and inclusion in a meaningful way, at least from your perspective as the regulator?
Yeah. So we have been really careful how we approach this issue at the FDIC, and here's why. I think a lot of times people, when they think about diversity, they think solely about racial diversity, and that's the most obvious type of diversity because it's generally based on the color of one's skin, and the easiest kind of a threshold to, you see the person and you kind of guess what ethnicity they are or race, etc.
Right.
So that's kind of the obvious way of looking at it, but diversity comes in many different ways. Comes from the socioeconomic position, educational level, comes from sexual orientation, comes from so many different angles that I think that just focusing on one aspect of diversity, which is race, is probably not going to do what needs to do to promote diversity efforts in rural communities where it's really hard to find heterogeneity. A lot of these communities are very homogenous. So at the FDIC, we look at this holistically. We look at our numbers, but frankly, numbers only tell you a part of the story. I would say that culture is not something that you can measure by numbers. So what I did at the FDIC when I first came, I wanted to know how are we doing on diversity efforts before we actually tell banks how they should be looking at diversity efforts, or how they may want to look at diversity efforts. And so I looked at the numbers. Numbers look good. And frankly better than most of government, but that wasn't enough. I said, well, how do people feel? So I went to the cafeteria more than once a week, put my tray at a table with different people. Some of them, it took them like 5 minutes to realize this is the chairman. But I would just ask questions about their jobs and job satisfaction and culture at the FDIC. Why did they choose the FDIC, etc. I rode a shuttle bus between our two buildings. And sat there on the bus and just talk to people. And when you do that, you start to understand that diversity is so much more than just what people tend to focus on. We expect our banks to do the same. We didn't really come out with a concrete regulation as to you should do this, you should do that, partly because we know how difficult it is for that small rural bank to find diverse bases. I know in a lot of cases these banks actually struggle to even meet the CRA requirements.
Right.
Because there's just the community, they may have 2 or 3 branches, as I mentioned, and the community is not as diverse. And there's not, and I would say even economically, the community is more homogenous than CRA would like, et cetera, et cetera. So I know there are a lot of issues. I would tell bankers, know what your staff brings to the table in terms of diversity. Know what your community looks like. Try your best to make sure that you have people at the bank who represent the community that you serve. Go as far as you need to create the sense of equity and inclusion and financial inclusion in your community. And if, despite all of your best efforts, you still don't end up with, perfect diversity record, whatever that perfect diversity record may be for you and your board, try more. But really, I think we have been really careful about giving people any kind of a set number of this
Sure.
or that. And we have approached this issue knowing that we supervise the largest number of banks in the United States, and most of those banks are actually very small banks.
Right.
And we know that a number of those banks are in rural communities, and it's really, really hard for them to meet not just the diversity requirements that you may impose on them, but even the CRA requirements, which shouldn't be as hard to meet
Sure.
as they sometimes are.
Great advice and great insight as to how to explore that in ways that are perhaps not as obvious as, again, as we spoke about race. Um, when you mentioned culture a moment ago and visiting with people on the bus and in the cafeteria, you haven't been able to do that in the past year, just as your examiners have not been able to come into our banks. I've heard wonderful things about the way the exams have gone, but from both sides, the bankers and leadership at the FDIC, you miss something by not being face to face. How are examinations planned? How are things being planned for the near and perhaps further future upcoming?
Great question. So when I came to the FDIC, I wanted to know how many days our examiners spend on the road in general, how many days would they spend inside a single bank, et cetera, et cetera. And so the numbers were, I don't remember, the number of days inside a bank depends on the bank size and complexity. The number of days that our examiners spend on the road, I remember it was about 80 something days annually. And I think it was 88 when they present me the numbers. And so what happens selfishly from the FDIC's perspective is that we lose examiners mid-career. And it takes us 4 years to train an examiner and over $400,000 in
Wow.
cost to train that examiner. So they're obligated to stay for about 4 years after that. But then after the 4 years, they don't have an obligation to stay at the FDIC really. And so what happens in year 5, 6, and 7, they go to work for your members. And which is wonderful because your members get really qualified and trained people. Should be wonderful from our perspective because it's wonderful to have an FDIC examiner there who now is a compliance officer who can actually help the bank do the right thing
Right.
and understand regulations and expectations from supervisors. But we lose examiners. And the number one reason for that, as we've heard, is the travel time and time spent at banks. So we initiated kind of the process of trying to reduce the number of days that our examiners spent on the road. Even before the pandemic. And I was told we will never be able to get to significantly lower number, whatever that number was, because of technology and demands, et cetera, et cetera. And then the pandemic happened. And what we had to do was go 100% off-site exams for over a year now. And we had to do it pretty quickly, within 3 weeks. And so, you know what happened? It happened that we could do that and not really lose the quality of exam. But I have to tell you what our examiners are concerned about is that there's nothing that really replaces that discussion, eye to eye with the management at banks, and the ability to kind of go inside and see exactly what's going on the premises. So we are going to, I would say in the next few months, start returning our examiners to on-site examinations. We're going to take the lessons learned from the pandemic, which is the utilization of technology, to better our exams, to make sure that they are more efficient. Maybe we send a smaller team, maybe they send a fewer days than before the pandemic, and maybe they're backed up by a bigger team off-site. And that's actually the same approach we did for bank closures. We closed 3 banks during the pandemic so far, and none of them related to the pandemic. I feel like I need an asterisk to tell people none of them closed because of the pandemic. And years ago, we used to send a team of 50, 60, 70 people to close the bank. And we were able to close the first bank during the pandemic with a on-site team of only 10 people. We called them the traveling 10. This was March of last year, which was really a tricky time to do this.
Right.
And then the last bank, the third bank we closed during the pandemic, we only used a team of four. We call them the fearsome four. And so we've learned that we can do so much more with technology that I think it would do our financial service system, our ecosystem of banks and bank supervision disservice not to utilize technology to understand moving forward how can we do our exams in a more efficient, better, shorter way, more off-site work, fewer days on premises, but the same quality and maybe even better quality of exam and feedback, and that's how we're going to proceed.
Appreciate that very much. Um, as we prepare to wind down our time together today, what do you think are the biggest opportunities or strengths for the industry in the years to come?
So I would say that utilizing technology, understanding how to utilize technology, in a lot of cases, a lot of banks this is the largest capital investment you have other than your buildings, which is technology, and you have to kind of stay on top of technology, not just for the products and services that your customers expect and that are evolving at a speed of light, really, in many cases. But for cybersecurity defenses, for anti-money laundering and Bank Secrecy Act compliance, investment in technology is going to be, I would say, the number one cost for a lot of banks and the number one area where the vulnerabilities in the system may really cause even failures in some case. I would go as far as saying that. So investment in technology, moving away from some of the legacy systems that are not evolving as quickly as the financial system is, and understanding, when you're able to do the investment to actually upgrade your systems. I would say that another issue that's going to be huge is cybersecurity. We all saw what happened with Colonial Pipeline, and I wish they were the only one. They weren't. It happens every day. And the fact that some of these bad actors now have customer service numbers where you can just call and they will tell you how to how to mine digital currency that they want for you to pay the ransom. It's like terrible. So I think that's an issue for banks to minimize vulnerabilities in their cybersecurity defenses. I would also say that understanding how people bank and how the banking industry is changing. What is the bank of the future going to look like, especially with rural area depopulation and more people moving to urban centers and a lot of these businesses evolving in business centers, metropolitan areas. What does that mean for rural banking and how to adjust and how to attract new customer base and compete with much bigger banks that have better economies of scale and efficiencies. And then I would say, lastly, and this is like not an exhaustive list, these are just things
Sure,
that come to my mind. I
absolutely.
would say kind of the competition I think we're at the precipice. I think we're at the fork in the road where we can utilize technology in a way that can allow banks to become more and more like technology companies and offer banking services and channels and not compete against technology companies, but be basically able to enter into symbiotic partnerships versus fighting the technology companies that may be doing what looks like a banking service, et cetera, et cetera. So finding that path for coexistence among the technology companies and the banks is going to be crucial to ensuring that we can use technology for the betterment of the financial system and the banking industry, and also to be able to offer more products and services at a better rate to customers. So using the technology and the competition in the system to be better and to
Right.
pass that on to the consumer and bring the unbanked consumers in the United States into the banking fold as well. So a lot of subtopics into each of these categories, but I just wanted to give you kind of my thinking about where I see challenges ahead.
Appreciate that very much. And you meant two words that you mentioned for my segue into the next question: fork in the road and coexisting. You have a new neighbor across the street
I have
with
a lot of new
a
neighbors
lot
since,
of new
since
neighbors
January.
across the street there on 17th on Pennsylvania Avenue. How has the change in the administration at the presidential level impacted the agency?
So I would say, every administration brings changes with itself, and I have I have a completely, well, not completely. I still have a director who's serving on an expired term, but I have a new OCC person, the new acting controller of the currency, sitting on the board as well as the acting CFPB director. So really, the board is, I would say majority of the board is new at the FDIC, and certainly the agenda has changed a little bit, et cetera, et cetera. But here's what I'll tell you. I told people before the election, not knowing who would win and who would sit on my board, that I intend to work well with whoever sits on my board, depending on the political persuasion. I think the things that we need to do for the banking sector and for the consumers in the United States is really something that should be apolitical. I personally really despise the fact that a lot of these things get politicized in a way that is just unnecessary and dangerous, because it doesn't lead to the betterment of our society and betterment of people. And so I hope that whoever ends up being a permanent replacement on the FDIC board is willing to work with me as much as I'm willing to work with them. And I certainly intend to greet everybody with open arms and see if they reciprocate.
Absolutely.
In the meantime, we're moving forward, and we'll continue with our agenda as much as we can, until I learn that we can't, and then we'll figure it out how to get around that as well.
Absolutely. Well, you echo what we say all the time. So many of our issues are really the vast majority are not political, and it's all about relationships and working together, working with everyone as people come into and out of seats on either side of the aisle. We appreciate your leadership and the way that you work with everyone in Washington, your new neighbors across the street, the leadership with the way that you have worked with the industry across the country, the transparency that you have introduced into the agency, the approachability that you have as chair is really remarkable. 25 years working in state bankers associations, I don't believe we've had a chair who is as approachable as are you, ma'am. We are grateful. That is sincere. We appreciate you so much. Thank you for being with us here virtually on Mackinac Island today. And you are invited to come back next year. And we hope that that you'll stay at least overnight next time and spend some time with us.
Oh,
Thank you
well,
so
thank you
much.
so much. I can't wait for the 2 flights, 1 car, 1 ferry, and 1 buggy. No, it's been phenomenal. Thank you again for the opportunity. I do hope to see you in person soon. Thank you all for what you're doing on the ground, and I hope we can continue to work for the best of the United States of America together in a bipartisan, apolitical, fashion. In the meantime, stay well, stay healthy, and God bless you all.
Absolutely. God bless you too, ma'am. Thank you.
Thank you. Bye bye.